Hello and welcome to Ask You for a Trend. I'm Josh Lipton. For the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Tuesday takes a tumble. Wall Street did end the day in the red after a strong rally at the close. All of the major indices did end lower. We're digging into some recent consumer trends, and the outlook may be bleak. More and more people are defaulting on their auto loans. And the definition and the price tag of a luxury home in America is changing. It may be a buyer's market, but sales seem to be slowing. We'll tell you everything you need to know about high-end real estate. Well, a new report from VantageScore shows a troubling trend in the auto loan market. Delinquencies are climbing more than 50% since 2010, and it's not just from risky borrowers. For more, we're bringing in Rikard Bandebo, chief economist at VantageScore. Rikard, it is good to see you. Let's start out with auto loans, because you were breaking down that data, and it was interesting, Rikard. What you say now, correct me if I have this wrong, but you call it the riskiest credit product now. What is going on there? What are the trends? Walk us through it.
So what we saw was that Q1 of this year, actually auto loans became the riskiest consumer credit product. And that has been something that has been evolving over some time. So what we did is we actually, because this is a question we get asked by lenders and economists all the time, what's going on with these auto loans and the delinquencies. So we went back and looked at the data going all the way back to the end of the last recession. And what we see is that actually, going back to the first quarter of 2010, at that point, auto loans were actually the least risky of all consumer loan products. And now, this year, we now hit the point where it's the most risky one. And during that time period, what we saw was that every other loan category actually has seen their delinquency rates go down from the first quarter of 2010, whilst at the same time, auto loans have gone up over 50%.
Is that, now what are the reasons for that? Is that affordability? Is that people are they biting off more than they can chew? What are the variables?
Yeah, so we did a big study. We pulled in our data, we pulled in data from the government data and did a big regression analysis. And what we found was that there are really two themes that are driving this. First one is very much, as you insinuated, is affordability, right? So as we look at, for instance, average loan sizes, we've actually seen that in this period of 15 years, the average auto loan has gone up faster than any other product, including mortgage, right? It's gone up 57%. So on top of that, in terms of affordability, more recently, we've seen interest rates go up. So that's kind of a double whammy on your monthly outlay, right, for your auto loan. Not only has the principal gone up, but the interest payment has significantly gone up as well. And given that auto loans are typically one of the second or third biggest outlay in an average household on a monthly basis, that's a pretty big hit for many consumers.
When we talk about, what are the consumers that are, Rikard, most vulnerable when we talk about auto delinquencies?
So, like always, you tend to see that obviously subprime consumers have higher delinquency rates than others. But what the interesting trend that we're seeing here is that a couple of years ago, as these auto loans started to rise more quickly, a lot of auto lenders adjusted their lending criteria. But that didn't stop the delinquencies increasing. What we saw was that, yes, we saw that subprime auto loans actually reduced in risk. We saw less delinquencies from subprime based on their changes. But at the same time, we saw the amount of delinquencies coming from near prime and prime consumers going up quite a bit. So it's not necessarily then the answer that most people expect, that it's subprime. It seems to be that there are challenges with those people that are actually from higher income households and have had traditionally better credit health.
So we talk about the consumers. What are the kinds of lenders, Rikard, that would be most vulnerable here?
So, I think that obviously we're seeing an improvement in the delinquency rates for the subprime auto lenders, but again, that's always a big risk there. But again, the issue we're seeing now is the increase is hitting higher, or the rate of increase is higher for those near prime and prime auto loans. And so that's probably ones that are a little bit more concerning at this moment.
Do you watch auto delinquencies, Rikard, as an economist, as any kind of, is it like a canary in the coal mine, so to speak?
It's definitely telling, because it's such a big outlay. And also, unlike other credit products, a lot of people are very reliant on their car, right? And if they don't make the payment, somebody's going to turn up one day and they're going to take that car away. So they really want to make sure if they need that car to get to work, that they make that payment. So it's obviously pretty high on what they call the hierarchy of repayments. And so what it's telling us is, not surprisingly, that there's a growing number of consumers in the US who are struggling to make ends meet. And in that light, as we look at the data, As we're looking at the consumer right now, we're actually seeing that they're probably the most precarious in terms of credit health that we've seen since the end of the last recession.
And what explains that exactly, in your opinion?
So, it's a combination of, the situation with employment and incomes. We've seen a lot of people with the costs having grown disproportionately since COVID, but their incomes haven't necessarily kept up, right? So they're struggled then between outlays that have increased a lot, whereas the incomes haven't. And so how are they being able to make ends meet? Well, they can reduce savings, but those who didn't even have enough ability to reduce their savings are then having to face the question of which bill am I going to pay, this bill or that bill?
Now that struggle you're highlighting there and that you're seeing in the data, Rikard, do you see that persisting?
So on the bright side, we're actually seeing that on some unsecured products like credit card and personal loans, we may have hit a peak already. So we're starting to see there some of the year-over-year delinquency rates are beginning to come down. However, on secured loans, such as auto and mortgages, those are continuing to increase. However, the rate of increase is slowing down. So the big question is, are we going to see sort of a peak of these delinquencies, and are we going to start seeing them ebb and maybe come back into a better place? That's the unknown, but the optimists of us out there are hoping that will be the case in 2026.
Well, let's stick with the optimistic take. Rikard, great to see you on set. Thank you, sir.
Thank you.
Stick around. Much more Ask for a Trend still to come. The S&P 500 and the NASDAQ snap winning their streaks as Oracle leads, tech stocks lower. Yahoo Finance's Jared Blickery joined us now with trading day takeaways. Jared.
Thank you, Josh. Well, no records of note to celebrate, at least in the major indices, but I have noticed that volatility is creeping higher. So I thought we'd take a look at the VIX. And just as a reminder, this is the prime time part of the year in October and November when we see the VIX tend to peak, and there is a seasonality to this. So here's a SIBO volatility index, and just as a refresher, when the VIX goes higher, this actually reflects institutional hedging activity. This is based on S&P 500 options going 30 days out. Some people call it a fear index. Some people take issue with that, but nevertheless, when it goes up, that's usually means stocks are going down. And so this goes back 3 months. What I want you to, and this is very noisy, but I want you to notice that it is trending down over this first half, and now it is just ever so gradually turning up. And so this is almost like a rounded bottom right here. And so this is almost setting up for a spike higher. We don't know what the catalyst is going to be, but structurally it looks like volatility wants to tick up. And so that's just kind of a yellow warning flag for the markets. Are we selling everything right now? No, just a yellow warning.
And what do the pros have to say about volatile prices?
Well, I would go back to Mr. Buffett. He has something that he calls Mr. Market, and he actually got this from Benjamin Graham from his days at Columbia a long time ago. But I had the opportunity to talk to someone on the Stocks and in Translation podcast. This is Michele Galina, and she had this to recount about Mr. Buffett's Mr. Market.
The market is essentially this moody person who comes to set prices every single day, just like you and I have moods. And right now, Mr. Market is euphoric about AI and tech, but that doesn't mean that at some point in time he's going to be fearful or scared or nervous about what that industry might be facing from a challenge perspective. And so that Mr. Market theme essentially gives you the knowledge to say, hey, at any point in time you might be higher or lower than the norm, but likely the market's going to revert to the norm in the meantime.
So it's kind of a story of mean reversion here. That was the message of her little parable. And we talked about a lot of different things, diversification, a lot of stuff for beginners and advanced pros as well. So you can check that out. It is live now on the Yahoo Finance site, the Stocks in Translation podcast.
Should we do a quick check on crypto?
Let's do that, because I was talking yesterday about all these false breaks to the upside and to the downside that we see in Bitcoin. And after a record high on Monday, I was warning that, well, we could go down. And what I wanted to see hold was 120,000. And guess what? That's exactly what held right here. So no rug pull just yet. Here's a 10-day chart, still looking pretty green here. Let me just give the 6-month. And that'll be pretty good because we had this trading range that had set up early on. We spiked above it. And so this was kind of a rug pull. Took out this range right here too. But now we have this more established trading range. We broke above. What we want to see is 120 hold and then kind of stair step higher. So far so good. But if we close below 100, well, Bitcoin doesn't really close, but if we move and stay above below 120,000, that would be an orange to red warning flag that once again, we might be testing the bottom end of this range somewhere below 110,000.
The yen's been on your radar.
Yes.
Any update there?
Yeah, we had a surprise weakening yesterday after a surprise election result. Let me see if I can find my yen board. I do have it here, and there we go. So these are non-standard forex pairs, and that is because the Japanese yen is first in all of these. And this is a 2-day look now. So I'm going to look here, and you can see a lot of red. That's because the yen has been weakening, and that's why I chose these particular forex pairs. And we have both of those on the Yahoo Finance site. This is the Japanese yen, and you can see that it doesn't move, it doesn't trend a lot, except maybe sideways, but it is noticeable that we're at the lowest point on this chart. And if I put a max chart here, you can see we are pretty much in the lowest area going back to the turn of the last century. I would also point out that the yen versus the euro, where is that right there? And this is also a max chart. The yen has never been weaker versus the euro. And so this brings to mind the yen-mageddon incident that we had in August last year. There's a whole carry trade. I have been assured by experts that the carry trade is not in danger of unwinding and spilling over to US stocks right now. So this was on my radar, but it doesn't seem to be an imminent problem. Nevertheless, if you're in Japan, inflation is finally a problem after decades of deflation.
All right, thank you, buddy. We'll leave it there. Stick around, much more Ash for a Trend still to come. The luxury housing market is cooling. Redfin data shows luxury home prices are still rising, up 4% year over year, but sales have fallen to their lowest August level in more than a decade. For more, we're bringing in now Chen Zhao, head of economic research at Redfin. Chen, it's good to see you. So let's start big picture on this luxury housing market. You have some stats, Chen. Prices up, sales down, inventories elevated. What explains this trend?
Yeah, I think what we're seeing right now in the luxury housing market is very similar to what we've seen in the rest of the housing market the last few years, which is that it's just really frozen. There doesn't seem to be a lot of demand. Like you said, there is more inventory than a year ago, but there isn't as much inventory as there is in the rest of the market. And sales are very low. They're really at historic lows right now, even compared to the rest of the, very sluggish housing market. So it seems that what is happening is that these buyers are really pulling back, and whether that's because of economic uncertainty or it's something else, I think that those are things that we can talk about, but it feels like there's not a lot of demand right now.
And when we talk about the luxury housing market, Chen, how do you all define that?
We define it as the top 5% in each market. So one thing that you might naturally think about is that a luxury house in St. Louis is not really going to be the same as a luxury home in Miami or in New York City, but we define it as the top of those specific markets.
It's interesting, Chen, because when I might have assumed if we're talking about this, luxury housing market, with the stock market doing what it's doing, Chen, just record, a lot of folks focused on that kind of house, focused on that kind of market would have been feeling relatively pretty good.
Yeah, I hear what you're saying, but at the same time, I think a lot of buyers are looking at the luxury market right now, and they're seeing that the housing market as a whole, prices are getting very soft. In a lot of the places where you think about where luxury homes are, like in South Florida or in LA, I mean, these are some of the places where prices are the softest. So I think some people are worried about catching a falling knife. They're saying, well, if prices are coming down, then, or price growth is really coming down, maybe there's going to be more of that in the future, and I should just wait. I think folks are also thinking about, where is the economy headed over the next 6 months or a year? Because we did have a lot of policy volatility earlier this year, and we haven't really seen that completely play through yet.
We've been talking there nationally, Chen. What are some regional differences you would point out? Maybe, pockets of strength or weakness?
Yeah, so right now, in terms of prices, we're seeing that prices are the highest actually in West Palm Beach. They're up about 15% year over year, but very close to that, is Tampa, and their prices are actually down 5.5% year over year. And then if you're looking at sales, we're seeing that sales are down about 19% in Miami. But on the flip side, if you look in Indianapolis, their home sales are up about 19%. And I think that's a testament to sort of the relative affordability in a place like the Midwest.
Does what happens in the luxury market, Chen, does that matter for the broader U.S. housing market? Are the two correlated in any way?
They are very correlated. You do see that, what's happening in the luxury market is similar to what's happening in the rest of the housing market. There are very stark differences, obviously, between the two markets. However, obviously, luxury buyers are much less affected by mortgage rates. They're more likely to be all cash buyers. A lot of times, people who are, buying in the luxury market also have more optionality. So, for example, if they don't like, where prices are going, sellers don't have to sell. They might just choose to hold on because they have the financial flexibility to do that. They could rent it out if they like what's going on in the rental market, for example. And a lot of times people who are looking at the middle of the market, they just don't have that same financial flexibility.
How much, Chen, do rate cut expectations matter for the luxury market?
I think they still do matter because, like I said, when we're thinking about luxury, we're thinking about the top 5% in each market. So obviously for, a luxury apartment in Miami or in New York, a lot of those buyers are paying all cash. They're not really thinking about mortgage rates. But a luxury buyer in other parts of the country are, a lot of times they are still financing. So they are still thinking about where are mortgage rates. They're thinking about what the Fed is doing. And this is another instance where I think people are worried about catching that falling knife because they're seeing that the Fed is cutting now, and they're thinking, well, the Fed is going to cut more, so maybe rates will fall more, even though, we know that those price cuts are already priced into mortgage rates today. But they might also be thinking, hey, look, if the economy weakens more, we could actually get even more price cuts from the Fed, and that means mortgage rates will go down. You're
an economist, Chen, so I'm just curious. You look at your crystal ball. How many cuts are you expecting over the next 12 months?
Wow. Yeah. I think that, the market expectation is 2 cuts right now. I think that is a good baseline expectation. But it really all depends on this economic data. It's too bad we couldn't get that jobs report last Friday because I do think that what we're seeing in the jobs report, especially the unemployment rate, that's really what is going to be driving how many rate cuts we see.
So the 30-year fix, Chen, Mortgage News Daily says 6.38. What do you think? Where are we 12 months from now?
I think 12 months from now, we're probably pretty flat to where we are right now. But there is a lot of uncertainty. Like I said, it really just depends on what happens to the labor market. If that labor market starts to really weaken, if it seems like we might be on the cusp of a recession, we could see much significantly lower mortgage rates. But if we're seeing what we're seeing currently, which is that the economy is weakening, but it's still holding on. And there's still that threat that inflation could tick up still from, higher tariffs. That means that, mortgage rates 6 months from now, probably also 6.38.
Chen, always good to see and to have you on the show. Thank you.
All right. Thanks so much for having me.
Well, that's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet.